we are looking at here. Let's actually welcome in Vaibhav Sanghavi, who's now with us to run us through what he's making of things. He's CEO of Ask Hedge Solutions. Vaibhav, beyond the big picture but it's all big picture now, and not very many people are looking at sort of bottom-up stories because everything is being brushed aside in the same color. What are you doing, Vaibhav, at your fund? You guys can do long short. What's the sense and what are you up to?
Prashant, I think markets in a way are extremely kind of volatile in the sense that every day is a new day, right? I mean, at the end of the day, what are the developments and what is the subsequent impact in terms of the portfolio? It's extremely tricky to kind of take a medium-term view on that. So, from being a long short fund and having the liberty to kind of go on the opposite direction as well, kind of helps us to kind of hedge the portfolio effectively during these kind of time periods. But when I saw what you had to mention about the China thing as well, I think one of our contention also is that on the trade tariff, it is not only about tariff. I think a lot would go also into in terms of the negotiating kind of deal, in terms of course, bridging the trade gaps. But two, in terms of the geopolitics, and three, in terms of kind of funding the US deficit by buying more US treasuries as well. So my sense is basically it will be all part of one big negotiating deal, which will come about with all the countries going forward. So interesting times, tricky times, but at least in the next couple of months, I think that turbulence will continue to be there on an overnight basis.
You were talking about your long shots, Vaibhav. Which side? How you're positioned currently and how has it changed, say, in the last couple of months or so?
See, I think over the last couple of months, I think we had written a note in terms of what we are thinking in terms of the change. And of course, one of the big risk factors was Trump tariffs in that. But what we are seeing, from FY26 and 27 perspective is, one, from a domestic side, we are extremely positive on the whole consumer segment. Now, it's not only about the defensive nature of the consumer segment, but also because that we have seen after 8-9 years of, government's sole focus on the supply side to now a combination of welfare and in terms of the consumer rebates as well in terms of the tax. So what we do think is that increasing the disposable income in the hands of the consumer at the end of it will see to that the momentum in spending kind of increases. And especially into sectors where there are, good experiences, or probably, going to restaurants, malls, and over and above some amount of discretionary items as well. Lastly, to be followed by the staples. So all in all, the whole consumer space is something which we are bullish on. And at the same time, what we are turning a little kind of to neutral from being very positive is basically the banking sector. Purely because as we look at rates kind of come down, we may see some amount of pressure on the margins. And as we see the turbulence on the economic side, where the exporters will have some tough time, maybe probably some amount of stress on those kind of books as well. So that's a segment which we are currently getting neutral from being bullish, from a portfolio perspective.
Any sectors which you're short on, cautious?
So all the global sectors, including metal mining, probably also on autos who have a global exposure. I think those are the sectors which we are avoiding. And lastly, I do think that if the global growth is going to weaken, then it will have a direct impact on the cap goods industrial side, as well. So industrials is something which we should probably avoid as well, purely because the valuations there are not cheap in any case.
And IT pharma? Vaibhav?
Yeah.
You spoke about export-oriented sectors like metals or global companies with auto companies with a global facing. But what about IT and pharma?
See, IT, I think it has been beaten down really badly, and probably we are looking forward to the next 10 days in terms of the results and the guidance. Not that it would be anything kind of exciting. What we may probably happen is basically because of these results and the guidance, we may find some amount of bottom happening post the declaration of numbers. So let's wait for that. in our view, when the free cash flow yield kind of starts to look pretty attractive on these companies, there is some amount of bottoming will be made probably in the next 10 to 15 days. So we will have that view. Pharma is, again, wait and watch. Let's see what happens from a tariffs perspective, and then we'll probably take a call on that.
I think I just saw Coforge up on the screen. Coforge high was about 10,000 rupees. It's fallen to about 6,000 rupees. And Rima, I think I remember speaking to Sudhir Singh.
Yeah.
He's
Very
bullish.
He's like front foot and everything first, right? I mean, I don't know if the commentary has changed. The last time, of course, this was all not there, this tariff talk, etc. So we've seen very, very sharp falls in that sense. And tomorrow, of course, we'll ask TCS. I mean, what are they hearing, and if they're able to, if they've heard anything so far. And I think that should set the tone beyond the numbers for Jan to March. Vaibhav, any thoughts on OMCs, oil marketing companies? Again, oil prices have come off very. The only thing is, marketing margins are very robust right now. Will oil stay here? Because in COVID, there was real demand destruction, right? Right now, the destruction is mostly financial markets. So the price of oil can also swing sharply based on what happens to financial markets.
Of course, Prashant, I think while that's a second order or third order probably impact in that sense, but what we have seen in terms of increase in excise duty by 2 rupees per litre, in our view, the OMCs may not be allowed to make profit in excess of a certain amount, which probably will have to be contributed to the government coffers in that sense, which is to build up some amount of cushion on the fiscal spending side. So my view is that as oil keeps on correcting, while we see some amount of decrease in prices on the consumer side, but some part of, again, will kind of keep on chipping away to the government kitty as well. So in that sense, yes, current profitability looks good, but as global growth weakens, refining margins will start to come under pressure as well.
Okay. All right. So not a positive look. I think there was an Ambit note today. They are talking about between 50 and 100% upsides here for oil marketing companies. Sort of in the morning, look for it. But I mean, there's a fair bit of interest here, especially now with